good morning and welcome to the next wave trading. On this video, we will talk about Japanese candles. Today, we will know a little bit about the candlestick patterns. I want to give you some advice. First, remember that operating financial markets using margin has a high level of risk. It is not recommended for all the investors. Remember that before you invest inside these markets, you need to carefully consider which are the objectives of the investment, what is the level of experience, and of course, the attitude to risk. Plus, remember that any opinion given in this webinar is provided as a general comment in the market and it does not constitute an assessment of the investment. So let's start. Today we will see how the Japanese candlestick work. Some of you already know how to handle Japanese candlestick, but some people do not. And this webinar was made for you to learn how to use them. I will explain you what a Japanese candlestick is, what is it made of, how you can interpret them, and the different kind of double candlestick that exist. Plus, we will also know what their function is and 5 candlestick patterns that we consider all traders should handle, which are hammer and hanging man candle, bullish engulfing, bearish engulfing, also the morning star, because some people know them with their names in English and Spanish. Here we have the options so you can understand what we are talking about. So let's start with the first part. We will know the Japanese candlestick. First, what are them? There are many ways to read a graph. We can use Japanese candlesticks, bars, lines, points, and figures. There are many ways that we can use to analyze how the price of an asset is moving on a certain period of time. Which kind of graphic should I use? I recommend you the candlestick. They bring us a lot of information. They are easy to use and they work. Remember that this is a personal topic. You must choose the one which works best for you. How do I know if the market is volatile? Candlestick will tell us that there is so much volatility in the market. When they have a big wick at a top or at the bottom, and when they have a small body, that means that there is volatility in the market. If there is a small candlestick where the maximum and the minimum are close, it means that there is not so much volatility in the market. What is Japanese candlestick? They are a visual representation of the movements of prices in the markets. They are one of the most popular components of technical analysis. They allow investors to easily obtain information related with the price starting from just a few price bars. So now, what is the composition of candlesticks? In trading, candlesticks are composed by 4 prices. So, top wick, the body of the candle, and the bottom wick. Now, as you can see, this is the red candle, and this means that the candle is going down. This is the maximum price, the opening price, the closure price, the minimum price. Now, when the candle is green, it means that it's going up. So it's also the maximum price. Now it will be the closure price. Here will be the opening price. And here will be the minimum price. What does it shows us every part of the candlestick? Top wick, it shows us the maximum point of the reached price. Bottom wick, it shows us the minimum point of the candlestick reached on a determined period. Candlestick's body, it will be red, green, or blue. The color of the candlestick will depend on where the opening or closure price of the candlestick is. It's easy, right? Now let's go. What does the color of the candlestick mean? If the candlestick is red, it is a bearish. If the candlestick is green or blue, it is a bullish. How do we interpret them? It is time to know how we can interpret Japanese candlestick on an easy way. Here you can see that it's bullish. Here you can see that it's less bullish. Here you can see that it's neutral. Here you can see that it's less bearish. And over here, you're going to see that it's bearish. Now we are going to talk about the types of dodgy candlestick. Dodgy candlesticks are popular and widely used in trading as they are one of the easier candles to identify, and their wicks provide excellent guidelines regarding where a trader can place their stop. Now I will show you 5 types of dodgy candlesticks, and I will tell you why they are so important. The classic dodgy is a single candlestick that does not signify much on its own. To understand what this candlestick means, traders observe the prior price action building up to the dodgy. Now the long-ledge dodgy symbol has a greater extension of the vertical lines above and below the horizontal line. It shows that indecision between the buyers and the sellers. By the other side, the dragonfly dodgy, this one can appear at either the top of an uptrend or the bottom of a downtrend, and signals and potential for a change in direction. Gravistone dodgy is the opposite of the dragonfly dodgy. It appears when price action opens and closes at the lower end of the trending range. Now we are going to talk about Gravistone dodgy. It's the opposite of the dragonfly dodgy. It appears when price action opens and closes at the lower end of the trading range. For price dodgy, simple, a horizontal line with no vertical line above or below the horizontal line. This dodgy pattern signifies the ultimate indecision. Now it is time to know other types of candlestick that exist in trading. So are you ready to start? First, the hammer candlestick. A hammer is a price pattern in candlestick charting that occurs when a security trades significantly lower than its opening, but realized within the period to close near the opening price. The hanging man is a type of candlestick pattern. The candlestick displays the high, low, opening and closing prices for a security for a specific time frame. Candlesticks reflect the impact of investor emotions on security prices and are used by some technical traders to determine when to enter and exit the trades. We are going to change to the bullish engulfing. This pattern appears in a downtrend and is a combination of one dark candle followed by a large hollow candle. On the second day of the pattern, the price opens lower than the previous low, yet buying pressure pushes the price up to a higher level than the previous high, culminating in an obvious win for the buyers. The piercing pattern is a 2-day candle pattern that implies a potential reversal from a downward trend to an upward trend. 3 characteristics of this pattern include a downward trend before the pattern, a gap after the first day, and a strong reversal as the second candle in the pattern. Morningstar. It is a sign of a reversal in the previous price trend. Traders watch for the formation of a morningstar and then seek confirmation that a reversal is indeed occurring using additional indicators. Let's check the next one, that is the twister bottom. As reversal patterns, twisters are quite popular with traders searching for clues for when the market will change direction. Let's check the bearish engulfing. This one The pattern can occur anywhere, but it is more significant if it occurs after a price advance. This could be an uptrend or a pullback to the upside with a larger downtrend. Let's see for the next one, the dark cloud cover. This one, the pattern is significant as it shows a shift in the momentum from the upside to the downside. The pattern is created by an up candle followed by a down candle. Traders look for the price to continue lower on the next candle. This is called confirmation. Now for shooting star. A shooting star is a type of candlestick that forms when a security opens, advances significantly, but then closes the day near the open again. Candle, the twister top. The twister top, a twister topping pattern occurs when the heights of two candlesticks occur at almost exactly the same level following an advance. Twisters are more meaningful as part of other trends, especially pullbacks. That's all for me today. I will see you in the next wave trading.